Hi, I'm Jason Odom, and I'm joined today by portfolio managers Aaron Brown, Geraldine Sundstrom, and Emmanuel Sharif to talk about PIMCO's latest asset allocation views. Thank you for joining us today. Geraldine, starting with you, how is PIMCO thinking about overall risk in portfolios today?
We see the global economy at the mid-cycle point. And while the easy return of the reopening boom in 2021 are likely behind us, we still think this is an environment where we want to be overweight risk, albeit selectively. 2022 is a year where our base case is for above trend growth and inflation that eventually moderates, and where most of the bottleneck will ease significantly. This results in an operating environment that is likely to be easier for most companies. Of course, there are some significant tail risks that are associated with this base case scenario, and therefore, portfolio will have to be managed with a great deal of flexibility and caution, as well as a big emphasis on security selection.
Thanks, Geraldine. Looking more closely at each asset class, Aaron, can you please walk us through PIMCO's views on equities and rates?
We are constructive equities and believe that equities provide the best opportunity for dispersion and alpha generation next year. While we're cognizant of the risks of the gradual removal of accommodative central bank and fiscal policy support next year, we believe that still above trend global growth, strong corporate discipline, and sustained profitability next year will drive solid risk-adjusted returns. On a sector basis, we're taking a barbell approach to portfolio construction. On the one hand, we're long cyclical sectors, such as industrials, machinery, and mining, that are expected to benefit from the US infrastructure deal and the build-out of a greener future. On the other hand, we're long secular growers in the tech space that we think are going to be able to take advantage of a greener, brighter future ahead. For rates, we expect that government bond yields will trend higher over the cycle as central banks raise rates and are therefore underweight rates across our positions. Although inflation break-evens have moved significantly higher, in our view, they still do not fully price in the appropriate inflation risk premium given the potential for a left-tail outcome over the months to come. And in this period of transition, we think that active management of fixed income portfolios is going to be key to harvesting alpha and generating outperformance.
Emmanuel, can you elaborate on where we are seeing potential opportunity within the credit and currency markets?
Certainly. Given that we're in an economic expansion, corporate earnings and therefore corporate credit markets should generally remain quite healthy for the time being. However, at these very tight starting levels of spread, there just isn't that much upside for spread compression in corporate credit compared to equities. But there are still some opportunities to participate from time to time tactically when spreads widen. And there are also good opportunities in select single names, mostly in COVID-affected names, both in IG and high yield, where we rely on our credit analysts for assistance with selection. And one area where we still see really good opportunities is in structured credit, especially non-agency mortgage-backed securities, which are really well supported by rising house prices and very healthy consumer balance sheets. Now, with respect to FX, the dollar and DMFX in general is mostly trading with monetary policy expectations. So we only take tactical exposures there from time to time. And with regard to EM and EMFX, this is an area that hasn't recovered quite as quickly. It still screens cheap in many of our models, and there are opportunities to earn carry there. However, EM also faces very significant structural headwinds, so we want to be very careful about how we size our position and remain quite controlled there.